Welcome to another episode of Money Script Monday. My name is Andrew Keene, and today I'm going to answer the question, is an index universal life a bad investment? Well, first, I've got to be clear that an index universal life or an IUL is not an investment, at least not in the sense that many of us has been trained to think about. But if you look up the definition of investment on investopedia.com, it comes up with the definition that's on your screen. So an IUL is generally considered a long-term savings vehicle. It's a life insurance policy that has cash value growth that's tied to the stock market, but is not directly invested into the stock market. Now, what I want to talk about briefly today is why an IUL should be something you consider as part of your long-term savings goals and part of your retirement plan. Now, to do that, I'm going to first talk about the characteristics of investments, then how an IUL policy may fit inside your retirement plan, and then lastly, I'm going to talk about the importance of how an IUL is structured. First, let's talk about the characteristics of investment. So what is an investment? Basically, when you invest, you're taking capital, whether that's capital or over a period of years. You're basically putting this capital to work with the pursuit of profit, whether that's interest, income, or appreciation. Now, it's important to note that when this capital is not inside a Roth IRA or Roth 401k, the gains, the appreciation, the income, the interest can all be exposed to taxes, whether it's capital gains or ordinary income tax. Now, how do you invest? Well, you basically choose investments based on your personal investment profile and your long-term and short-term goals. Now, some investments provide you with more upside potential over the long run, but you also have a higher chance of loss. Now, by taking more risk, you're exposing yourself to losing value. And in order to offset those values, you can choose lower risk investments. Now, typically lower risk investments have lower return potential, but you also have the lower chance of loss. Now, with investing, you don't have to choose one or the other. How does that tie in the index universal life? Well, with an IUL, really, we use this policy for asset protection. And what type of protection does an IUL offer? Well, first and foremost, an IUL offers permanent life insurance coverage for your family, your business, or even your favorite charity. It also offers tax protection. So you have access to the growth inside your policy, and you'll never pay taxes on it if you structure the policy correctly. And your heirs will have a tax-free death benefit. So if you're concerned with taxes, IULs are definitely a great fit. Now lastly, the other protection that it offers is protection against stock market losses. With an IUL, the way it works is you have growth potential from an underlying index like the S&P 500. Now you're not going to receive all the gains, but over time you'll capture about 60 to 80% of the stock market gain. Now there's going to be some sort of limiting factor, perhaps it's a cap rate or a participation rate, but the trade-off for that cap rate is an annual floor of 0%. So that means you're never going to lose value inside of an IUL. Now, when the stock market does really well, you're going to capture the stock market gains up to the limiting factor. And if the stock market has negative value, you're going to receive a 0% floor. So you're not going to have any losses, and your previous gains are going to be locked in. Now, some IULs do offer a fixed option. And if you've seen some of my other videos, you understand how valuable it is to never lose money. So if you look at the chart on the screen, it shows you how valuable not losing money is. So this is a diagram showing investing $100,000 into the market over 22 years. At the end of the period, you'll see that you would have ended up with about $261,000 investing in the S&P 500 strategy. Now, using the IUL strategy during the same time period, you would have ended up with almost $500,000. Now, the reason behind this drastic difference is because your IUL account is linked to the stock market, but it never directly participates in it. So it receives a portion of the gains from the stock market, but when the market goes down, it doesn't experience any of that loss. Now, I'm sure you've been told you need diversification. So this is where an IUL also fits in. You get asset class diversification, you get tax diversification, and you're protected against stock market losses. Life insurance is what's called an asset, meaning you can do multiple things with your money simultaneously. Now, most investment strategies only allow you to do one thing with your money. You can either invest in the stock market or you can invest in real estate. However, a properly structured life insurance policy allows you to borrow against your policy and take that money and invest it into real estate or invest it in the stock market or invest it somewhere else. So your money stays inside of your policy continuing to grow and you're investing your money somewhere else. So now your money is working in two places at the same time. And not only that, it's providing tax-free passive cash. So let's move on to the importance of the policy structure. So you can either design a policy for a high death benefit or a high cash value. And most of us are used to seeing life insurance built for a high death benefit. So the way we structure a policy is we always want to buy the least amount of death benefit that the IRS allows. So the reason being is a lot of the fees of the policy expenses, the cost of the insurance, the surrender charges, they're all based off the death benefit you purchase. So if you purchase the least amount of death benefit that the IRS allows, less of your premium goes into the life insurance expenses and fees, and more goes into the cash value growth. You also want to fund up to the maximum deposit that the IRS allows. The IRS limits how much money you can put into the cash value side of the policy, and this is based upon the initial death benefit of the policy. So basically, if you put too much money into the cash value, it turns into what's called a modified endowment contract and then is considered an investment, not a life insurance policy, and you're going to lose some of the tax favor treatment that the IRS has bestowed upon life insurance policy. So it's really important to work with a qualified advisor who is looking out for your best interest and constructs these policies appropriately with the least amount of death benefit and funds right up to the guidelines without going over. Now, it's also important that you live up to your end of the bargain as well. One of the great features of IULs is that they're flexible in design, meaning that you can fund up to the maximum deposit, you can fund to the minimum deposit required just to cover your policy expenses, you can miss deposits, you can make up deposits, and sometimes the flexibility can lead to disaster if you're not funding these correctly. So what that means is your policy is not going to perform efficiently, and more of those deposits and cash value will go to cost and less to the cash value growth. So again, it's crucially important to not only work with a qualified advisor, but also set up your policy with an adequate amount of funding so that you can comfortably afford not going over your budget. If you want to learn more about the structure of a policy, I've got some other videos out there. And I want to leave you with this. So often IULs are compared to Roth IRAs. Now they are different financial vehicles. However, they do share some of the same characteristics. For instance, they both grow your money tax-free. Their growth is based on your investment choices. However, IULs offer benefit Roth IRAs do not offer, such as protection against stock market losses. You can contribute a lot more money into an IUL. There's no income limitation to contribute money into an IUL. IULs offer long-term care and critical care protection. They give you access to your money, and it allows you to grow multiple assets at the same time. And then, of course, they allow you to call what's called a family banking system. Now, I hope you've learned something from today's episode. I look forward to seeing you again.